Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah, and we're both with Client First Capital. And so, Amar, today we're talking about retirement savings mistake people might be making and not even realize they're making this mistake. And we have a list of 6 key mistakes. And do you know where we got this list from?
I'm guessing it's polling our clients' children.
Yeah, so this is just things we hear from our clients, right? And
Yeah,
from people who we're working with or who are trying to save for retirement, and we just see that they're making these mistakes, right?
yeah,
And so, all right, so let's I'll kick off the first one. We'll just kind of go back and forth as we go through this. But here's the first one that we see way too often, which is why we have it number one, is people are just not saving enough for retirement. And here's what I hear from people is, I'm early in my career. I'm starting a family. I've got all these financial pressures. I'll make more money later and I'll have a better opportunity later, right? So let me postpone, but I'll just make it up then, which we both know that's a terrible idea. You should always save for retirement first. But I'll chat your comments.
yeah. I think uh, you know one of the the seven wonders of the world. So maybe the eighth wonder of the world is compounding interest, right?
Mm-hmm.
Is that the value of time value of money. So the earlier you start, even if it's a little bit, the more those funds actually grow over time. And it could be those dollars that offset later years where you have to save larger dollar amounts. So um, even if you feel like you're in an entry level job and you can't save anything, even saving a little bit helps.
Yeah. Okay. Well, here's another one, and some people may not feel that this is a mistake, but if it's one, if you can avoid it, it's worth it. And that is sometimes people rely too much on one income.
Yeah, I think there's pre-retirement and in retirement, right? And
Mhm.
so like if we look at uh, pre-retirement, if everything's coming off one income, there could be a side job or real estate business or something that you could do on the side to get consulting income or something that income could go all towards savings and help build a nest egg on a faster pace. On the other hand, in retirement, if you're only focused on one piece, stream of income as your total retirement, there's some risk there, right? And so, like if you look at pensions, if you're in the airline industry and your whole focus was that one pension from American Airlines or something like that, you know, when those got restructured, those payments were drastically reduced, and that could really impact your retirement.
Yeah. And, for younger people, if it works for your family dynamic, having two incomes a lot of times helps people reduce their debt or not go into debt in the first place, right? In addition to increasing their savings and their retirement savings. So, and then the third one is something that we talk about a lot, and 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 I'm going to say the way I usually say it, Amar, is don't turn down free money. And
Yeah,
so you want to add some detail behind that?
yeah, it is eye-opening how many people we talk to about their benefits package that
Mm-hmm.
they're not taking advantage of free money.
Right.
That's they leave it on. Don't leave it on the table. It's there. The first thing I think that sometimes people overlook is the match. If
Right.
your 401k has a match, and you may not be in a high tax bracket, so you're like, oh, I don't need to put in a 401k. uh, Maybe put in a Roth 401k, you can still get a match, right? and,
That's
and
right.
so I think match is the first one. The second one is sometimes people have employee stock option plans,
Mm-hmm.
and you could put money in there and sell it virtually the next business day, right? And most of the time you get 2 periods of when you can invest in a company stock option plan 6 months apart, and you can get the lower price of those 2 periods, and some companies offer another discount to that price by 15%. So it's an
Yeah.
automatic savings that you could get, and in addition, a bump up even if you sell it the next day.
Okay. All right. So, the next one that we come across, Amar, is I think it's a mistake people make when they're thinking about their future expenses in retirement, and they're failing to, or they're underestimating the cost of healthcare.
Yeah, I mean, healthcare is a big cost in retirement. It's a big cost even before retirement. I know with a family of four, it's a sizable premium. But a lot of people think that Medicare is going to take care of everything, and it doesn't. It just simply doesn't. Dental, vision are not big pieces of Medicare. So not only do you may have specialists that you need to see, but there's things that are beyond the scope of Medicare in terms of coverage. On average, retirees spend about $300,000 on healthcare throughout their lifetime. The net present value of that.
Right.
And so it's important to include a sizable cost in retirement into your planning for healthcare.
Yeah. And, I would just add to that, some people are looking to retire at a younger age, 57, 58, 60. We're seeing that often. And so you've got to figure out also, how are you going to bridge yourself for the cost of healthcare, from the time you retire till you go on Medicare. Right.
Yeah,
So
especially since we've gone through these COVID years, if you will, people have realized that, they don't want their old job anymore. They want to be out and be retired.
Yeah, that's right. That's
Yeah.
right. Okay. So, so our next one is, and this one is something we see people typically when they're closer to retirement or transitioning into retirement. It's mistakes that they make, but really it's just poor tax planning.
Yeah, poor tax planning, poor withdrawal strategy, poor tax efficiencies within the investments, right? So just to recap, you want your buy and hold investments to be in your taxable account. You want your transactions and bonds to be in your IRAs and 401ks, and you want your long-term growth portfolio to really be in your Roth IRA. That's an oversimplification, but from a high level, that's what we're looking at in terms
And so
of.
what's your risk here is, man, you've done a good job throughout your life saving and investing for retirement, and then you get there and you don't have the right strategies, and it impacts your spending or your earnings, and basically it impacts the quality of retirement that you would have, right?
Yeah,
it's a big deal.
Yeah, and the extra percentage that you're paying in taxes could have been going to your lifestyle, right?
That's right.
It's not like your lifestyle is it's costing more to have the same lifestyle, said another way.
Okay. So Amar, those are 6 mistakes that we see way too often. And when we bring it up to a client or potential client, in most cases, they didn't even realize they were making the mistake, or if they did, they didn't realize the amount of impact that mistake would have in the long term. And so, so I thought this was a good discussion.
Yeah, I agree. Thanks, Cary. For viewers watching, if you haven't already, please hit the like button. It helps other people just like you find our content. If you get a moment, please visit clientfirstcap.com. That's our website. And subscribe to our monthly newsletter. We go over retirement topics, tax planning topics, and estate planning. Thank you for watching. Bye, Cary.
All right. See you, Amar. Thanks.
Yeah.